Good afternoon, everybody. I think we are good to go. Hello, my name is Brian Forrester. For those who don't know me, I lead the investment management practice here at Deloitte in Dublin. I was going to say it is great to see everybody, but of course I can't. I guess it's great for you to all see me if you haven't done so in the last little while. As we all begin to get back to the office, I think hopefully we'll be able to meet in person a bit more often. I'm delighted to welcome you all to this webcast where we look at some of the current hot topics that are affecting our industry at the moment. Just before we came on, I was told by the team that this is the largest acceptance list we've had for one of our webinars, which I'm putting down solely to the fact that I advertised this as the hottest ticket in town on LinkedIn last week. Now, I do hope that I won't be accused of false advertising before the end of it, but I do hope there's something in this for everybody. I hope you enjoy the session, and as I say, I hope that that you leave kind of refreshed and up to date with a couple of important topics that are there. You did hear just a couple of housekeeping points. You did hear that the webinar itself has been recorded. We will send around a link to this afterwards along with the slides. And so people will be able to access the webinar afterwards. If you just flick onto the next slide there, please, just in terms of, we're going to run this as 3 separate sort of standalone brief presentations on the 3 topics, which I'll come on to in a second, but we do want to make this interactive. There is a chat function, a question function, if you can see there on the right-hand side. If you just scroll across to the right under questions, please at any point in time throw in a question in the box. And then we'll come back at the end and have a panel discussion and try to get to as many of those as we can. So it'd be great if we can have some questions, and then, as I say, we can have a bit of an open dialogue with the panelists. In terms of the agenda itself, I'm going to throw over quickly to Julie Farron, who's going to give some updates on the whole area of digital technologies. I maintain I'm too old to talk about that now, so Julie will bring you through some of that. Sustainability, very hot topic at the moment, which Mark Abu, who's one of the directors in our risk advisory team, is going to bring you through. Certainly, as I'm talking to boards at the moment, partly through audit processes, but partly just in general about business updates, very, very hot topic, very much something that's on the agenda, and I think something that we're going to see evolving quite a lot going forward, but Mark will give you a bit of an update on that. And then just at the end, the gift that keeps giving, CP86, I'd call it CP86 2.0. Before we get to CP86 3.0, I think it's good to just reflect on where we are today, how we've got there, and Noel Maloney, who's a senior manager in the risk advisory team, will give a little bit more thoughts on what we're seeing in practice and what firms might want to think about going forward. And then, as I say, we'll come back at the end for some Q&A. So that's all for me for the moment. I will come back at the end, but I think for now, if I just hand over to Julie, and she'll bring you through some information around digital technology. So Julie, over to you.
Thank you very much, Brian, and I don't think you're that old when it comes to digital technologies. So thank you very much, everybody, for joining today. For those of you who don't know me, by way of introduction, my name is Julie Farron. I am a director on the consulting side of the house here locally in Deloitte, Ireland, and I lead out as an investment management sector lead for consulting for investment management. So flicking over to the first slide there, please. So I'm here to talk to you and present on our white paper, Deliberately Digital. It's a piece of research that we conducted during 2021, looking at the adoption of digital technologies across the investment management industry, looking at wealth managers, asset managers, and asset servicers. We conducted a survey with 18 senior leaders across the sector, and the purpose really was to get an understanding of the digital technologies that they're adopting, where they are with regards to digital maturity, but also to uncover the barriers to digital adoption that the industry is facing, as it has been a slow mover in comparison to its sister industries, banking and insurance. So around some of the context, digital adoption is an increasingly important source of competitive advantage. Our previous research within our asset manager and asset servicing surveys identified tangible differences between leaders on data technology and laggards, and we wanted to drill a bit further into this. Three questions that we posed during our survey and our research were, firstly, what are the main objectives that managers are trying to achieve by adopting digital technologies? Secondly, how do managers characterize their digital maturity? And thirdly, what are the key barriers hindering managers' progress towards their digital technology objectives? And as I said, we interviewed 18 senior leaders, and we interviewed across wealth managers and asset managers predominantly, but we did include some asset servicers as well to get their lens. We interviewed individuals like Chief Technology Officer, Chief Customer Officer, Chief Digital Officer, Chief Distribution Officer, Head of Client Service, and Head of Client Data Science, as these are the areas that we felt were important to interview. So if we move on there to the next slide. So to dive through some of the key findings first, before we go into some of the colour around it. On the face of it, the market appears uniform. Investment and wealth managers share a high degree of three high-level objectives for adopting digital technologies. So firstly, for enhancing their decision-making process. Secondly, for increasing operational efficiency. And thirdly, for improving the client experience. However, managers profoundly differ on the sequencing and emphasis of individual objectives. Some are taking operations-led approach, others have adopted for investment process-led approach, and some are arming the front office to become world-class and best at what they do. Most managers categorize the overall digital maturity of their organizations between enhancing and innovating. But the picture is a bit nuanced when you actually go under it. So in some organizations, their business functions are either at the reimagining phase, so they're highly automated, or they're still at the exploring phase. So that was actually very interesting. The pace of change is accelerating. The industry has made real progress on its digital agenda over the past 3 to 5 years, and an increasing number of managers are moving up the maturity curve. However, the industry still faces three principal barriers to adoption, and that was found in these three were consistent amongst wealth managers, amongst the asset managers, and the asset servicers. And that was firstly strategy. So there's a lack of clarity on how digital technologies enable the business strategy, and inconsistent execution of strategy are creating uncertainty for the digital initiatives. Secondly, people. So cultural issues such as resistance to change, and underestimation of the shift in mindset and ways of working required, and skills gap. And thirdly, resourcing, so that issue of a finite resources available for digital initiatives and giving rise to competing priorities. Yet managers have powerful tools to which to overcome barriers, and managers that do overcome these barriers will see widespread benefits from faster and more effective technology adoption to more satisfied clients and investors. So if you flick onto the next slide, please. So investment and wealth managers share three high-level objectives for adopting digital technologies: investment, operations, and client experience. So given that managers ultimately live or die according to investment performance in the front office, there's a real focus on digital enhancement. A clear trend is for automation of low-value tasks, such as capturing data, to liberate time for core decision-making activities. The full extent to which tasks carried out by the front office people could or should be automated is actually open to debate and vary according to front offices. What is clear and is crucial is that we should not lose the human judgment in the investment making decision process. That is the secret sauce to the industry. Looking at operations, there are three challenges within operations: legacy, integration, and processes. So speaking to one asset manager, they say that if you look at the big budget spend of the past few years and they're coming up, dealing with legacy is certainly a major objective for adopting digital. So more spend is going towards the legacy issues instead of the spend going towards the digital initiatives. One wealth manager pointed out that we're building an end-to-end wealth business and we have the challenge of the business unit integration. We're clunky, therefore operational efficiency is high on their agenda. So once again, challenges around integration from M&A. And as the asset servicers pointed out, its processes, they're still dealing with too many manual processes, and they're absolutely a focus. So how they get those processes automated is a key priority within the asset servicers. If performance is king when it comes to investment management, then client experience is queen. So improving the client experience, of course, and that seamless investor journey is critical to the industry. So creating a single view of the client to understand their interactions through all touch points, using data management platforms to build more granular client segments, and giving that clients and the investors smooth online self-service journeys with richer investment data. So to move on to the next slide, please. So here we have the science on the page, the maturity curve. So most managers and wealth managers, asset managers, and the asset servicers that we interviewed are landing between enhancing and innovating on the business model. No one overall is in the exploring phase, and nobody is in the reimagining phase. So everybody is doing something. However, when we looked at some of the business functions within the organizations, some of their business functions were actually up the reimagining, and some of them were still in the exploring. But overall, the industry is landing between enhancing and innovating. So everybody's kind of in a similar position. We move on to the next slide, please. The industry has made real progress on its digital agenda over the past 3 years. And an interesting point that one wealth manager stated was, we've moved a huge amount in the past 3 to 4 years, and we've learned a huge amount about where our bottlenecks and challenges are. And that's critical for adopting strategies, a digital adoption. Identifying where your bottlenecks and your true challenges are. And in reality, as they stated, unless you're shifting all aspects such as IT operations, underlying technology, you just won't become a digital business. Another important something that a wealth manager said was a sense of more ownership and more innovation. To him, where the key word was scale, and scale is important. So we're not just dabbling anymore or trying to solve a pointed problem. We're looking at a business model change. We're looking at how automation and digitalization in general can unlock profitable, scalable growth. So the key word there around digitalization is how it's going to help them scale their business. Overall, the market's pace of change is accelerating, and an increasing number of managers are shifting up the curve to a stage where they will use digital technologies to innovate their business and operating models at scale. And as this happens, the implications are clear. It will become harder for digital laggards to catch the leaders. The market is likely, therefore, to see further defensive consolidation as the quickest means to acquire the sought after digital skills and capabilities. We move on to the next slide, please. So managers are adopting a range of digital technologies to achieve their main objectives, with data, cloud, and platforms being most frequently cited. So enhancing the investment decision-making process through the use of alternative data sets, through blended data, through the use of AI, and then through platforms. So connecting operations, risk management, and the investment management process via a single platform. Increasing operational efficiency, so looking at automation, how they can incorporate the AI family into creating those operational efficiencies and automation within their back-end operations. Cloud, so we are seeing the move towards cloud. Platforms, so re-platforming core process as well. So we are seeing trends in core platforms and new core platforms being integrated into the business. And process re-engineering, so looking at simplification of processes as well, where processes are potentially being over-engineered. And the introduction of agile, so moving away from waterfall delivery, moving away from the concept that the solution needs to have all functionality before it goes into production and goes live in the ops environment, and moving towards more agile delivery, starting with MVPs and building upon that. And then improving client experience. So once again, platforms are critical to this. Data is critical. Digital channels, so replacing the digital channels with more interactive digital channels, such as apps. And then the UX, providing that slick online client service experience to both clients and investors. So if you move on to the next slide, please. The pandemic has accelerated digital technology, and we spoke about this last year as well as part of the asset servicing survey, where we questioned, was the pandemic the foe of the industry or the friend? And it turned out that although the industry faced challenges both asset managers, wealth managers, and asset servicers at the start, it had actually been the friend of the industry. And the reason for that is it has accelerated digital initiatives. So the key top 5 areas where we're seeing this acceleration is cloud, alternative data sets, platform, automation, and digital channels. And just to point out what one asset manager said, COVID-19 did in 2 weeks what it would have taken us 2 years to negotiate internally in terms of online channels. In our organization, it's meant that we're doubling down on tech. It has accelerated our ability to deploy our investments because we're not distracted by other channels or other opportunities. So if we move on to the next slide, please. Looking ahead, the main barriers to adoption related to strategy, people, and resourcing. So strategy, so the lack of clarity on how digital technologies enable business strategy and inconsistent execution of strategy are creating uncertainty for digital initiatives. Secondly, people, so cultural issues such as resistance to change and underestimation and shift in mindset and skills gap. And probably something to point out that one COO stated is that the portfolio manager of the future is a data scientist. That is a huge workforce transition. And then resourcing, a lack of funding, the high cost of major change, difficulty prioritizing initiatives, and difficulty updating legacy technology at pace and scale. So if we move on to the next slide, please. Yet managers have powerful tools which overcome barriers to adoption. With regards to strategy, articulate to the internal audience how digital technologies will drive competitive advantage and empower digital leaders to drive in development and execution of business strategy. With people, build an enterprise-wide culture of innovation that hinges on reskilling, attracting new talents, and optimizing the talent model. And lastly, with resourcing, rethinking prioritization, looking only to prioritize those initiatives that will add value to the organization. So I'd like to thank you for your time today, and I'd like to, regarding digital, deliberately digital, I hope you enjoyed the overview, and I'd like to pass over to my colleague, Mark Aboud, who will run through sustainability. Thank you.
Thank you very much, Julie, and Brian as well, and good afternoon to everybody. So my name is Mark Aboud. I'm a director in the Risk Advisory Department with a specific focus on sustainable finance. So just moving on to the next slide, please, Rosie. And before we look at 2022, it's often useful to look back at last year, but specifically some of the outcomes that came out of COP26. There's a lot to be positive about, but I think a lot of areas that require further work and further focus. Firstly, at a government level, we saw a number of pledges being made, particularly from a coal, a deforestation, and a methane emission perspective. If you'd like to move on, please. We also saw nationally determined contributions and commitments being made by all countries as well. From a corporate perspective, we saw the IFRS Foundation, which established the ISSAB, the International Sustainability Standards Board, which are planning to create standards by mid this year, similar to IFRS financial reporting standards, but for sustainability. The Glasgow Financial Alliance for Net Zero is an alliance representing $130 trillion of capital, which are committed to basically transforming or transitioning to a lower carbon economy or a net zero economy. And so a lot of focus on that. And then finally, from a global finance perspective, I think some positive steps happening in that area as well. I think it wasn't all positive. There were some areas that require further attention. For instance, rich countries didn't make clear pledges for supporting the finance transition in less developed countries. If you'd like to move on to the next slide, please. That received a lot of media attention. The language on certain pledges was watered down, and we particularly saw that for coal. And then current national pledges put the world on track for a 2.4 degree world, which is well below the objective of COP26, which is 1.5 degrees. So COP27, which is this year, will be hosted by Egypt. So we should see a lot of focus on those areas, particularly the national pledges over the course of the next year. So just moving on to the next slide, please. And staying on the theme of global finance, we completed a white paper last year specifically focused on sustainable investing. And And dedicated sustainable investing, what we found, will more than quadruple in size, totaling in $13 trillion in assets under management worldwide by 2025. And what we mean by sustainable investing is portfolios actively promoting environmental, social, and/or governance characteristics as a primary investment objective, rather than those considering such factors, many other investment inputs. And just moving on to some of the three key drivers behind that report, we found that sustainable investment will be global in nature, and this will be driven by the EMEA, US, and APAC regions. And secondly, it will be accelerated by conversions. So nearly half of the growth worldwide will come from converting existing strategies to sustainability-focused investment processes. And then thirdly, it will be fueled by investor demand. So investors are expected to drive 3.2 trillion in net new flow into sustainable development strategies. So I think really interesting report, really interesting figures, and we've included the link there for further reading when we share the materials post this webinar. So just moving on to the next slide, please, on the evolving ESG landscape and some of the themes that will be driving some of that over the next year or so. And the first one is over 2/3 of the global economy are committed to some type of net zero goal, and organizations that haven't considered transition risk when planning investment in future lines of business need to do so now or will likely fail. We're seeing a lot of focus on pledges, but we'll see more focus this year on actual transition plans to meet those pledges. So I think, from a regulatory perspective, that's something to be quite focused on. Secondly, there's been a lot of focus on the E of ESG, but we're starting to see a shift towards the S, the social element. And this has been heightened through the pandemic in terms of workers' rights and labour relations. Incidents like the death of George Floyd and other such incidents have put a significant focus on the social aspect, and rightly so. We're starting to see the interrelationship as well between the E and the S. For instance, an extreme weather event in the East Coast of the US may impact or cause social displacement for certain communities, or similarly, the conflict between the E and the S, divestment out of certain hard-to-abate industries, may result in unemployment for certain communities or areas around the world as well. So I think it's something to be cognizant of, and something the regulators are focused on as well, in terms of rolling out an EU social taxonomy to build on the EU green taxonomy. Thirdly, and moving on, when we think about environmental issues, we tend to think about carbon emissions and the greenhouse effect, but we're starting to see a shift in focus towards nature and biodiversity. And this is much more difficult to measure. A ton of carbon in Ireland is the same as a ton of carbon in China, as an example. So in terms of measurement, risk assessment, forecasting, it's completely different. I think most people, or most of the participants on this call would be aware of the TCFD, the Task Force for Climate-Related Financial Disclosures, but we're going to hear a lot more this year from the TNFD, which is the Task Force for Nature-Related Financial Disclosures. And then finally, as the planet looks to build back better after the pandemic, we expect conversations to shift from simply mitigating the negative effects of climate change to more discussion about adaptation and climate resilience. So the Next Generation EU programme is an example of that, an economic recovery package to support member states adversely impacted by the COVID-19 pandemic. I think there's a strong focus on digitization, like Julie was talking about, but also the green transition and social cohesion. That's the biggest economic package of the EU's put through. And then more closer to home, the Irish Climate Action Plan, which has committed 125 billion, which is a mix between private and public investment towards tackling climate change. So a lot happening from a policy perspective and building back better post-COVID. And I suppose this is all wrapped around, finally, an accelerated regulatory agenda, which is just going to continue to plow on this year and over the coming years. And I think we'll just talk a bit about that on the next slide. So the schedule for implementing ESG regulations is extremely tight. The first obligations have already started, but many obligations are yet to be implemented this year, and also rolling into 2023 as well. And I think one thing to note are the EU regulations are extremely interlinked. And that's the reason why we'll probably start with something like the taxonomy, which is a common language or the linchpin used in other regulations. The taxonomy amends, many of you will know, the SFDR regulation and defines rules for products with environmental objectives. It's extremely complex as a regulation, and it's all about the data. The delegated act for the technical screening criteria for the first 2 objectives came into force this month, and the remaining 4 objectives are expected for January 2023. And as I mentioned earlier, later this year, the EU will publish a report on the taxonomy and integrating social and non-green issues as well, and building on that taxonomy. For SFDR, many of you are starting, or hopefully starting to see the dust settle somewhat from level 1 SFDR implementation in March last year. You'll be glad to know, and you'll be aware, that the level 2 measures have been deferred again to Q1 next year. And although this is welcomed, the level 1 requirements under the taxonomy regulation still need to be addressed. And given the extent of the level 2 disclosure requirements, your organisation should use this additional time to continue with those preparations to ensure compliance with the level 2 regs. And then finally, from a EU perspective, the non-financial reporting directive has been replaced by the corporate sustainability reporting directive. This will expand the scope from 10,000 firms to over 50,000 firms. The EU will publish CSRD sustainability reporting standards by mid this year, and firms are expected to apply those standards in Q1 2023. So I think, you know, that will see a big uptick in reporting requirements, but also an increase in standard, because it will require mandatory limited assurance by an external auditor. And then finally, just included 2 regs from a UK perspective, the Sustainability Disclosure Requirements regulation and the EU Green Taxonomy, similar to SFDR and the EU Taxonomy. And early indications from the UK are that they will align to the EU regulations. And I think based on some of our analysis, it supports that impression. But I think there are a few areas that are a bit unclear in terms of convergence. So I think that's something to look out for as we roll out into 2022. And then finally, in terms of supervisory expectations, I'm conscious of time, so I'm not going to spend too long on this slide, but there's probably a couple of areas that will require significant focus from a regulatory perspective. The first one is around governance and culture, and I suppose the extent to which asset managers demonstrate a board-led culture that encourages serious consideration of sustainability, climate change issues across the organisation. So I think the focus on tone at the top, governance structures and competencies in the board as well, and board presentations. And then also conduct risk, how asset managers take into account the effects of transition risk on consumers and anticipate supervisory action on greenwashing. You know, we've had a number of corporate scandals over the last couple of years, like merger tracker scandals, PPI, etc. And wouldn't be surprising that the next big scandal over the next couple of years will relate to something like greenwashing or sustainability related. So I think that will be a key supervisory focus from a regulatory perspective. So I think that's a whistle-stop tour from a sustainability perspective. Happy to take any questions. I know there'll be a panel at the end, but I'm going to hand over to Noel at this point, who's going to talk through CP86. So thank you.
Many thanks, Mark, and hello to everybody. By way of introduction, my name is Noel Maloney, and I'm a Senior Manager here in Deloitte's Risk Advisory Department, focusing on investment management sector. And you're all very welcome to today's session. We're now going to move on and look at CP86, but not necessarily to go over the guidance itself, but to look at the friction points and actions that are being implemented across the sector, following the themes identified in the Dear Chair letter of October 2020. Some of these challenges and actions I'll run through, you will identify with. Some will offer food for thought, while some may make you think, is this something we need to consider for our firm? Moving on, within this slide, we see we're just going to make a bit of context around the timeline of CP86. 2016, the CP paper was released, and then following a thematic review of 2019, the Dear Chair letter was released in October of 2020, where firms were asked to submit a board-approved action plan for the operational, governance and day-to-day aspects of CP86 by 31st of March 2021. Now that we're in 2022, and even in the back end of 2021, we were seeing that the CBI were reaching out to our clients and checking in to see how they were actually implementing and getting on putting the action plan into place. What they were also looking at was what type of inputs and oversight the board had on the implementation of the action plan. So in essence, they were really just checking to see were firms doing what they said they were going to do. Moving on to the next slide, we can see the Dear Chair letter covered 7 key themes as follows: resourcing, designated person, delegate oversight, risk management oversight, board approval of new funds, the OED role, and the governance and culture. For today and for the time provided, we will focus on the themes highlighted. These themes very much vary from firm to firm based on size, scale, and complexity of the firm, PRISM ratings, and what type of conversations and communication you've had with your supervisory team to date. So moving on to the next slide, on slide 4. Moving on to the next slide, we're looking at the resourcing themes that were raised by the CBI. So what are we seeing? So due to the drive and the ask for an increase around structure, substance, and support of management companies of the CBI, we're seeing, and I'm sure you're seeing it as well, a very buoyant employment market for employees, which has led to some firms having difficulties in putting and filling these roles that the CBI are looking to put in place. And this is both from a designated person's perspective or the support for the designated person. For these positions, as we're aware, the CBI is heavily seeking that these positions are placed locally here in Ireland. For some of our firms, this request to place these positions locally is presenting friction points within the firm and the wider group due to the associated cost of these additional resources. As a result, what we're seeing is that a lot of our firms are going on CP86 educational drives internally within their businesses to ensure there's absolute clarity and transparency around where the source of these demands from the CBI are being made, and also, more importantly for the wider business, why these additional costs are coming up at the moment. What we're seeing is that some firms are offering relocation packages of staff within the wider group to Dublin, so opportunities are becoming available within the wider group for people, which means that the Irish firm can still meet its location requirements for the CBI. With the CBI request for less leverage and support on group resources, as they wish to see management companies largely independent of the group, we have seen some firms redirect roles originally earmarked for another jurisdiction to Ireland. So these costs, location, and staffing arrangements are causing considerable impact within firms at the moment, and it's these friction points that are really being called out with our clients as we have communications back and forth with them. As we move into the designated persons, the CBI highlighted in their letter shortcomings regarding the duties of the DP role, including the location, as we just mentioned, the quality of reporting, and some general aspects around the role itself. To meet these shortcomings, from a firm perspective, we are seeing our clients putting into place all locally placed designated persons. This is again is dependent on size, scale, and complexity of the business. The DP being such a critical role in CP86, sitting between the strategic and the operational level of the business, it's critical that the DPs that are actually being sourced by the firm are of sufficient seniority in their career and appropriately qualified to carry out the designated person's function and role. This is critically important for any firm, as if they're proposing a designated person and that individual were to be refused, this would reflect quite poorly on the firm. This kind of fits into the resourcing piece that we just mentioned and the difficulties around a tight labour market at the moment. From an individual designated person perspective, we have seen instances where some DPs who are put into DP positions were not necessarily acutely aware of the responsibilities of the designated person role that they've taken on or the managerial obligations that were aligned to it. In some instances, we actually saw some DPs who weren't even aware that a separate DP letter of appointment needed to be put in place separate to their employment contract. So it just kind of showed that the level, maybe there wasn't a full scope awareness of the guidance itself. From a functional perspective, there was a sense with certain designated persons of a lack of understanding of the managerial obligations, how to really boil them down, really understand them, and then how to report them up to the board and give the board that comfort that they are fully executing their managerial obligations. There are a number of grey areas around this for some DPs as they're being onboarded, and we here at Deloitte, we're actually working with DPs individually, providing training sessions as they are actually onboarded, so they understand what the expectation of the role is and how they fit as a DP within the wider management company. What we're also seeing, which is a great initiative with DPs as a group, is that an awful lot of DPs are working a lot more collaboratively together and collectively together. So holding monthly designated person calls as a DP team to discuss reports that have been received by delegates, and then discussing where the challenge will be actually offered of those delegates on their monthly calls. These DP meetings are actually critically important because it allows and ensures that DPs are not working in silo of each other, and it brings the management company DP function collectively together. And what it also does is it allows each DP to see a wider breadth across the firm as opposed to specifically being pigeonholed within their own managerial obligation. I think that benefits the entire firm on that basis. This then feeds into the next theme, delegate oversight. To meet the ask and the focus on delegation oversight that the CBI have called out, some of our clients have put in oversight frameworks that allows them to demonstrate and evidence that they are receiving and challenging delegate reports. This demonstration and evidence is critical, as we know, if it's not documented, it can be given that it did not occur. So these frameworks are really working quite well for a lot of our firms. These frameworks also try to reflect the management of potential conflicts of interest, particularly with proprietary mancos, where internally delegated functions oversight can be a bit lax, as opposed to third-party delegated arrangements. What we're also seeing is that there's monthly oversight calls with delegates are being put in place. Now, in fairness, this is probably something of a base expectation with regards to your delegate, but what we're seeing now is that there are standing agendas being put in place for these meetings, and they're actually being minuted on an ongoing basis. And then what we're seeing with some firms is that the OED then is actually reviewing these minutes and observing and looking where the challenges are being offered, how the funds are performing, and then this is actually feeding up into their quarterly report, OED report on a quarterly basis to the board. With CP 138, so CP 138 was published before Christmas. Firms are looking at the finer nuances of this. It's quite a meaty piece of work, I think. What we're seeing with our clients is that they would have had an outsourcing framework in place, but it does need to be enhanced. And so what we're doing at the moment, we're assisting clients to conduct gap analysis on their oversight frameworks and basically put a roadmap in for completion. Lastly, but not least, we have culture and governance. To satisfy the needs around culture and governance by the CBI, some of our clients have appointed CEOs, which is fantastic for the company because it kind of creates a structure, drives the tone from the top, and it sets the hierarchy for the firm. There's also been a focus on the jigging of board compositions in line with succession plans that have been put in place to ensure the right mix of NED and INEDs and gender balance, etc., just to ensure that the board composition is actively being reviewed, thought through, appropriate, and reflecting the desired evolution of the board. So I suppose in summary, from what we can see, there's been an awful lot of good work being done to date since the action plans have been implemented right across the sector. There are certain areas that need to be tightened up, absolutely for sure, there's no doubt about that, and there's certainly an awful lot of friction points out there, as I'm sure a lot of you are experiencing with your wider group firms. What I would suggest is that for anybody who hasn't been in touch with the CBI or your supervisory contact, is that you do a gap analysis of the action plan that you submitted last March, just to see what you've actually completed and what needs to be done, and just to ensure that you're on a good path for completion, because I've no doubt the CBI will be in touch very, very soon. I'll hand you back to Brian, but please do reach out should you wish to chat about any of the themes raised today. Many thanks.
Thank you. Thanks very much. No, and I might just ask you to stay with me, Noel, actually. And Mark and Julie, if you can just pop your cameras back on as well, that would be great. Feel free to move people around your screen to get them all in. We have had, I think, very interesting. I think all of the discussion. There's a lot going on, I think is one way to look at it. We've had a number of questions coming through, and again, encourage people to please shout and put a question into the text box that's there. There's one come through here actually about data, and Julie, I might go to you, and I think they might link into kind of Mark as well. But we talk an awful lot about digital and the kind of the benefits to the business. I mean, I think just in terms of, you know, the data, alternative data, what are we going to do with the data? I mean, have you got any observations on why that is such an important part of the digital journey at the moment?
Well, thanks for the question, who submitted it. So as we all know, data is like oil to our industry. We need data. It runs on data. You can't strike a nav without the data. So, and decisions from an investment perspective is made on data as well. So what alternative data is doing is enhancing the decision-making process as well. It's helping investment managers make quicker decisions. It's helping them make more informed decisions as well. And maybe just to touch around Mark as well on ESG, data is going to be critical for ESG. And at the moment, one of the core challenges within the industry is that we do not have a consistent viewpoint or a single source of truth on ESG data. And that is going to pose challenges, particularly around SFDR at the moment, and actually getting that underlying position benchmarked correctly from an ESG perspective. So at the moment, when it comes to data, asset managers and also some asset servicers who are building out their service offering are using a range of tools and a range of data sets in order to come to a single source of truth. So some have gone about using internal and setting up some ESG research teams and going in-house, but also complementing that with the external ESG providers as well. So using blended data sets in order to land somewhere in the middle regarding giving an accurate position. But over time, we should see in the next 2 to 3 years that a single source of truth will start to emerge with the data. But that is critical for helping managers regarding benchmarking for ESG. And then something that is going to be, so Mark, you probably might have an opinion on the data as well, if you just want to lean in there.
No, I think you made that quite easy for me. I think, you know, two of the things I jotted down there where the question came through, and I think you addressed it clearly, is, you know, there's a proliferation of data that's out there, and it's often inconsistent and uses different methodologies. And I think digitization provides a great opportunity from a sustainability perspective in that regard, and how it can provide firms with an air of consistency, whether it's through analytics, AI, or even, you know, newer technologies like blockchain, etc. So I think there's a great opportunity there, and I think even at policy level, with the Next Gen EU program that I mentioned earlier, the focus areas are on digitization, social cohesion, and the green transition. So already seeing them come together in terms of that investment criteria. So,
and maybe just to highlight as well, you know, ESG is top of everybody's agenda. So when it comes to that prioritization, and there's competing prioritization initiatives around digitalization as well, it comes back to that question of what's going to add value. So hence ESG will be prioritized in organizations around digitalization at the moment.
Yeah, no, thanks for that. I mean, I think that's really really interesting. I mean, Mark, just to pick up on another question that's coming through, and it's something that I guess is quite kind of close to my heart. If I think about the industry as a whole that we operate in and where the biggest risks are in this, I mean, we're seeing more and more this concept of greenwashing, and I think there's a real risk to all of us in the industry. That's the badge that we're going to be kind of labelled with as all of the various rules and regulations come through. I mean, is there anything that any observations you'd make around that, or anything you can suggest that people are just thinking of in trying to avoid that label sticking?
Yeah, I think there's some practical takeaways. I think from a like a governance and a risk management perspective, annual reviews of risk frameworks, incorporation of green considerations into product governance forums, etc. I think reviewing and updating senior managers' responsibilities, relevant committees, terms of reference, that kind of thing from a governance perspective. Within risk, I think identifying where products incorporate green credentials, establishing a plan to continuously identify and monitor and manage these to reduce the risk of greenwashing. I think setting up a process to monitor and manage climate-related risks and exposures from a product and a marketing perspective specifically. Develop like reporting on green products and continuously assess how if they're performing as expected, and looking at controls around valuation and MI reporting to ensure adherence to the relevant green standards. I think clearly articulating your ESG credentials and disclosures to ensure they're fit for purpose in terms of how you promote them. And I think finally looking across like the 3 lines of defence, I think upskilling relevant stakeholders from the first line to internal audit by doing like awareness, culture, training programs, and I think identify where the highest risk of greenwashing exists within your organisation as well is important. And I think I was talking to a leading academic on it a couple of months ago, and it's important to get those right to ensure you're promoting your products accurately and not greenwashing, but not green blushing is the opposite of greenwashing, where you might actually have a green product, but you're concerned about promoting that out in the market, so you're actually filtering it back. So I think balance is important there, and setting up some of those practical controls like the risk reviews, etc., are an important step towards that.
That's a new one for me, Mark. Green blushing. I think I've been concerned about the greenwashing, but green blushing is a new one for me. We've talked a bit in there about kind of culture and governance, I guess, and Noel, maybe just coming back in terms of the kind of the CP86. We talk about 2.0 and obviously there's 3.0. I mean, where do you see the bank going if you had a crystal ball? What comes next? And particularly in that area of governance in terms of some of the things that we're seeing on CP86, and also, do you think that sustainability will kind of fall under that? Can you see the central bank playing a role in pushing that sustainability agenda? A lot of what Mark's talked about is all the kind of EU rules and what so much, but not so much so far out of the central bank. What's your thoughts on that?
Yeah, I absolutely agree with that, and I 100% believe this is the direction of travel the CBI is going to be taking. It really does fit into that culture and governance piece that is being wrapped up around CP86, ensuring that you do have the right tone from the top, the right culture, and the right governance, whether it be of the firm or the products that you're actually investing in. A key piece around this, as Mark has touched on, is around the MI that's actually been received up, and making sure that, let's say, for the board members, that they actually understand what this MI means. It's easier to do the greenwashing if your board member doesn't necessarily understand what they're actually digesting or taking in. Sustainability as a team is the future. It's part of succession plans that I see with our firms that are taking into consideration, is making sure that they have the wit and the breadth and knowledge of the products that they are actually managing, so that they do understand and can contribute informatively to the actual, if it's an underlying fund, or contribute to the actual strategy itself. So it's definitely a team that's hot on the CBI's agenda for the future, that's for sure, and I don't think it's going to go away anytime soon.
Yeah, no, I think that is for sure. I wanted just to touch on the kind of the talent agenda just a little bit. I also wanted, I think, Julie, you were asking the question earlier, was the pandemic a friend or a foe? Well, I can tell you from my perspective, having avoided COVID for 2 years, I finally succumbed last week, and tomorrow is my final day of isolation. So it's been very much a foe to me for the last 10 days, as my family have treated me like a leper in the house. But I'm very much looking forward to getting out and about tomorrow and seeing what's happening. But I mean, I think that there's a question when it comes to change. and just the whole area of the talent side. I mean, how do you find firms have been able to bring the talent and the staff on the journey of that digital change?
So change is hard, and digital change is even harder. And, you know, we even heard it when we used to be back in Trinity in Adminovate, and they put it up on screen the last time we were there of that's how it's always been done. And, you know, when it comes to digital journeys, processes and how you do things today will not necessarily mean this is how you're going to do it tomorrow when you implement new digital technologies. And bringing the employees on that change journey is really, really important. It's really, really important as part of your strategy and that you consider what your change management program will going to be to complement the strategy of rolling out digital initiatives. And that's really critical. When we look at some of the talent and what some of the skill set is going to be for the future, data scientists are critical. As I said, data is the oil of the industry, but data scientists are going to be critical for analysing data. Other different roles will be in place, a lot of technology roles to support the industry. So people who understand the robot. So when the robot falls over, you know, coding is really important when it comes to the robot. Machine learning as well, understanding how the algorithms make decisions. Algorithms are coming more mainstream. They've been around for 50, 60 years, but we only have the technology now to really, really introduce them into the industry. So, you know, you can bring algorithms like decision-making trees into the back-end operations as well to create efficiency. So those are kind of some of the key skill sets as well. And, you know, coding, being able to code is going to be critical for app servicers and app managers as well. So having those developers, so it's not just going to be a business-facing skill set. There is going to be technologists required in the back end, and maybe some people might want to change from their front end operations and move into a more technology, you know, data scientists. Those type of roles, they're going to be critical. And then it comes back to those value add as well, looking at, you know, which are the value add priorities and bringing those people on the change and making them understand as well. So constantly communicating to your employees is going to be really critical as part of the journey. So making sure you have a solid comms plan to complement the change plan as well.
It's really interesting, and some good career advice there for my kids who are getting to that stage now, thinking about what to do next. No, you mentioned something interesting earlier, actually, which was just around, again, resourcing and I guess the location of some of the people in those DP roles. But and you mentioned the fact that you know, firms who would have had a role outside of Ireland are having to sell internally the fact that they need that resource to be in Ireland and then bring in senior resources in Ireland. Is there an opportunity here, do you think, for Ireland to almost be the exporter of resource back within the group rather than the other way around? Do you feel that, is that something where you think we can actually get to in time?
I think possibly in time it could work that way, particularly around the proprietary management companies. It depends what type of a management company I would suggest. If you're a third-party management company, you're obviously going to be located a lot of the time just in Ireland, and you might not be part of a wider group. But if you're looking for skilled resources and the likes of that, and these skill sets are now being requested here locally in Ireland, I think in time, potentially, yes, we could be going that way, in the sense that we'd have the SME sitting here in Ireland, and then it'd be exported across maybe to UK or New York, wherever the IM is sitting. But I suppose for the moment where we are with CP86 and the fund management company space, it's really trying to get the structure in place initially, and then pushing forward with these teams building in on top of them. But there's absolutely no reason why that's not the case, because the demands that are being made locally here in Ireland is for SMEs. It's not just people with a bit of an idea around these teams. You need to really understand the nuts and bolts of them. So that certainly is something for the future. Yeah, absolutely.
Yeah, it is interesting, and I guess anyone who has, you know, seen some of the kind of corporate transactions that have happened this week, there's been a lot of movement in terms of management companies just locally, and clearly resources is part of that, and I think scale is part of that, and being able to have that kind of, you know, robust operation of scale that can support the growth in the sector here. So look, very conscious of time. I always like to finish up on time. I'm just going to throw one last question to each of the panelists, and Mark, maybe just kind of starting with you, is really just, if you could leave the webinar and the participants just with one thought. What's the key thing here from a sustainability perspective? What's the one thing you want people just to remember as they finish up today?
So I suppose we believe that sustainability, it's a series of steps, and it probably finishes in integration, and before that comes your strategy. But at the very baseline is governance, and I think it's a term that everybody sort of mentioned today, and it's quoted quite a bit. So I think getting your governance right around sustainability, tone at the top, who's accountable, and that's your platform, and then focusing on your strategy, and then integration. So I think one takeaway from a regulatory perspective, sustainability perspective, is definitely focusing on the governance aspect of things.
That's helpful. Noel, what from your perspective?
Yeah, one takeaway for myself for today around the CPA6 piece that I was chatting about is just for individuals really to have a look at that action plan that is submitted last year, do a gap analysis. If the CBI haven't been in touch with you, chances are they will be in 2022. So try and preempt any type of questions that they're going to pose to you. And if there are any gaps on your action plan that you submitted back in March, make sure you have some type of a road plan or a response for the CBI. You don't want to get caught out on that. The CBI will be knocking eventually at some stage in 2022 for sure. So that'd be my takeaway for firms and individuals.
Something for everyone to look forward to with that knock on the door. And Julie, just the last word from you.
Probably just to re-emphasize that digital change is hard. It's not easy. It's really important, just those core 3 pillars that around your digital adoption, to have a clearly articulated strategy, to have a change management plan, to bring your employees on that digital journey with you. It's really, really important that you articulate your case for change and bring them through the journey. And also just around prioritization. Prioritization is really key, and really key at looking at the core value priorities that you have for your organization. And once again, just to express that the investor journey and that seamless investor journey is critical to the industry.
No, look, that's great. Big thanks to Noel, to Julie, to Mark. Big thank you for everyone who's joined us. As I said at the start, hopefully over the next few weeks and months we'll be able to get back to meeting in person. There was loads of content there. We could have filled that hour twice over with other things. We'll maybe do another one shortly. But look, thank you all very much for joining. Best of luck for the rest of 22, and we'll finish it up there. So thanks very much, everybody.